Round 6C. Let's take a look. Kind of glance at this, and we see the sales numbers are pretty lopsided, I guess would be a term. Andrews with nearly $400 million in sales, and the nearest rival at 138. So pretty good there, but the advantage increases more even then when you get to the profits, which are at 67 million versus 6 million, so 10 times in terms of profits. Pretty impressive for the one team. Obviously, you know, when you first glance, what are the two things that I'm going to tell you just looking at this statement that are contributing to that? And the answer first is contribution margin, which is extremely good. You know, 10 percentage points higher than Erie's, nearly 10 percentage points, 20 percentage points higher than Chester, its nearest rival in terms of profit anyhow. And not only that, SG&A to sales then was actually quite a bit less. So while Erie was within 10 percentage points there, they gave up, you know, 8 percentage points there, so 18 percentage points. And you know, not unlike with Chester, you know, Chester gave up 22 percentage points in terms of contribution margin and SG&A to sales. Of course, those are huge factors, but obviously the biggest factor is the overall sales. You know, what did Andrews do to drive those sales? I'll say, and as we're getting closer to the end here, I don't mind coming out maybe and pointing out some things that I probably wouldn't do earlier, but they quite obviously pursued their strategy, or it pursued its strategy to a greater extent than other teams. I would argue that in the beginning they were rather tentative, but the other teams were even more tentative, allowing them to take a lead, and they've pushed that advantage, and they have pushed their strategy quite substantially, I would say, in the last few rounds. So bully for them. They've done well. You could say they've been allowed to do well, though, also, you know, that there hasn't, yeah. Stocks we see still kind of a mixed bag here. Digby's buying back shares, it looks like. You know, Chester with shares outstanding. It looks like Ferris continues to issue stock. I really tried to, from the very beginning, hint around about the stock issuance, and you know, you can look at this and say that Andrews by far in the lead, and so their stock issuance didn't hurt them. Maybe if they didn't have, you know, these extra shares outstanding, their earnings per share would even be higher. As an investor, I'd like that even more. Could it have gotten by without the stock issuance at the beginning? And good question. I think probably so, again, because they were rather tentative at the beginning when they issued that stock. They raised money, but money that they didn't need or could have obtained otherwise, possibly through debt at the time, because debt's always cheaper than equity, right? You know, that said, you know, if I were playing the game, would I issue stock ever? Yeah, maybe. If I were going to do it, it would be in the first round, and I would make huge investments then into the company, because I would also, I wouldn't issue stock until I had borrowed all the money that I could possibly borrow, and then I would issue stock maybe if I thought there were some other things I could still invest in that might be worthwhile. And at the get-go, I would do that in a big way. And why? Well, in this game, you're given something that you're not given in real life, and that's that situation analysis that we did. You know what the growth of this industry is going to be, okay? You know, I forget what it averages overall, but 14, 15, 16%. I think we're told right at the very beginning. If I could borrow money at 12, 13%, whatever it is, and get a return of 16%, I would do that day in, day out. Okay, I would borrow as much as anybody would possibly let me borrow if I had that kind of a guaranteed return. You also have to remember that return's on a compounded basis, whereas the interest you're paying is simple interest. That may be kind of a confusing term, but that 16% growth rate compounds on itself. Okay, and so not only is the rate higher, but it compounds, and it's a, who was it, Ben Franklin or Albert Einstein said, there's no greater wonder of the world than compound interest, and and that's really why, that's why you take a look at doing that. So, kind of a throwback to, I guess, what I might have done at the beginning, but again, that's largely, I'm not trying to cast any dispersion. That's largely because I've seen the game played for 8 or 10 years. Honestly, I'd have probably been as tentative as other teams if I were playing it for the first time. Okay, net income. We get depreciation, obviously, a sign of how big companies are. I don't see huge changes in here. Chester got rid of some inventory. Erie built up a little inventory. Ferris got rid of a decent amount of inventory. So we see a few changes here and there. Andrew's still investing heavily in plant improvements versus other teams, no investment. Erie, small investment. So here's the team that's obviously leading the pack and then tripling down, doubling down, whatever you want to call it. Issued some debt. Look at that. $75 million in long-term debt. Turns out it probably didn't need it. It was probably a safety valve because it looks like they had $96 million in cash. But nevertheless, a decent safety valve. It had an emergency loan last time, which cost it some money. Now, you might think that issuing that kind of debt would cause a leverage problem, but its leverage is still at 1.4 or something like that. Take a look, 1.6. So still a relatively low leverage, by my standards, very low leverage. Okay, I'd like to see teams, lever up more, and then use that. Again, it gets back to what I was saying. If I knew I could expect those kinds of returns, I'd borrow money prodigiously in order to invest in that, especially in a game. Real life, of course, you wouldn't know for sure that you'd get those kinds of returns. Chester's still selling some common stock. I find that interesting, again, at this point in the game. Didn't need the $10 million in new equity, but sold the stock. Ferris selling a little bit of stock. I guess I have no idea why. Absolutely no idea why. At this point in time, you'd sell $657,000 worth of stock. Doing nothing but, it's not enough cash to make a difference. It has $10,627,000 in cash. So, that's the stuff just to the right of the decimal point there, basically. And yet, their shares are at $1 a piece, so it's adding 675,000 shares to its portfolio, which makes it that much more difficult for it to have earnings per share, and slightly more difficult to have a decent ROE. Okay, and it doesn't need the cash. Or it could borrow the cash, right? And so, and there's extra costs that come about from issuing stocks. So, again, I'm not holding as much back now because we're towards the end, and I don't mind giving a few pointers when I doubt they'll make a lot of difference. Looks like Erie must have had a small emergency loan now. Not enough to trigger a penalty, but just a little bit of bad management. Otherwise, a decent amount of cash. Digby Chester on a decent amount of cash. Andrews on a lot of cash, but Andrews' cash is based on that $75 million that they issued there, right? Okay. Andrews becoming a big team, but it has to be. It's selling a lot of stuff, and so it needs to be a big plan. So there's no getting around that. We see other teams, shrinking down a little bit. Ferris, Baldwin, pretty small. Digby, pretty small. Nothing wrong with that. Small equity amounts. Ferris actually at negative equity. Boy, that'd be interesting if it could get its equity up to like $1, which it's getting. It's not too far off. And then even get a small return, a small positive. It could win the ROE battle. Okay, so that would be kind of an interesting turnaround, wouldn't it? But that can happen. Okay, doesn't mean it would win overall scoring, but it could certainly win that ROE battle. And as an investor, you guys might argue that doesn't make a lot of sense, but as an investor for that particular period, that might be the better choice. Okay. Yeah, we got the sales and the income statements. We still see here too that, other fees, write-offs, TQM, and this is our TQM that primarily we see Andrews still, and while leading, still investing a lot of money in those things, as did Erie this particular time. So able to and this comes right off of the the bottom line. So able to generate a $67 million profit after investing close to $20 million. So if they took that investment out and nothing else changed, right, they'd have what, $87 million. Okay. Your taxes would change, obviously, so it wouldn't be that great. Here again, here's something, and this I haven't really hinted around. I've tried to be very, very vocal about this, but you have 1, 2, 3, 4, 5 teams that all have capacity in excess of production, first shift production. That is costing these 5 teams so much money. Okay, again, it's kind of hidden costs. Because unless you put a pencil to it really and look at your financial statements properly and whatnot, it's you don't realize what that's costing you. Yeah, sure, Andrews is paying time and a half, but even so, it's done an effective job of driving down labor costs and whatnot, much lower than other teams. Okay, so producing and using second shift is not associated with higher cost. Although if you're looking simply at the variable costs, it can. Okay, but these teams here, especially Baldwin, Chester, with lots of excess capacity. Okay, either they're not producing enough, but it might be because they're not in position to compete, and I think that's the case, or it just has too much capacity. Okay, too big. The company's really too big for what they're producing, what they're selling, what it's producing and selling. We see some inventories, although just glancing over here, you can see it looks to me like the low and traditional ends got pretty well sold out. There's a few traditional products here that Baldwin had. I think because those things are kind of outside of the circle maybe, and just were looking for a home, and that's why they were called traditional, I guess. They're probably closer to the traditional than anything else, but nevertheless still kind of looking for a home someplace. And Ferris down here with 433 units in the traditional. Looks like their age profile is just horrible, right? It's hard to sell a traditional product with 4.7 age, okay? Positioning is probably not that great. Price looks like it's over the top, okay, of what's expected there. And it still doesn't have any margin, so take a look. I guess when we get down here, what was that one for Ferris? Fist, yeah, 9.1. So Fist is Fist is actually not too bad. Okay, it's positioned pretty darn well, but its age profile is just horrible, right? And then the price at 31, price being the second one, it's $4 over the top end. Okay, if you're going to be over the top end, you better have a product that's got everything else going for it, like age and those types of things. And so, even though it didn't spend, it's just hoping to pick up a few scraps, it looks like to me. Okay, all these products sold out. Able isn't the best positioned either. I mean, that's an age profile of over 3. That's not that good. But you see what happened here is all these other products that were positioned similarly sold out, and that's why Andrews had still had a decent potential here, probably because of their spending, its location, things like that, had a decent potential, but sold actually more. Chester had more potential, could have sold another 6-7%, so missed out on some bucks there. And Erie had quite a bit more potential than what it sold. So Andrews could have got knocked back a little bit, certainly in the traditional segment. In the low end segment, and even though we classify Andrews as a differentiator, okay, still dominating in the low end. Usually you'd think that a differentiator would be dominant in high end, which they are, but also dominant here in the low end. Okay, what's causing that dominance? Well, again, we look here, right? Age profile, a little better than some of these other ones, closer to the 7 or 7.6 or whatever is that they want. MTBF price is reasonable, no big deal. Okay, spending a decent amount of money, okay, on promotion. Okay, had good accessibility and customer awareness coming in. Okay, and so those things were important coming in. You know, performance a little bit better, size a little bit better than some of the other ones that are here, even though those aren't huge. Okay, so just huge differences there. The high end, this is one of those I want to look at because Andrews is certainly dominating here with 58% of the market share. I kind of wanted to go back up because I found this is kind of impressive. This is a little bit unprecedented. I don't know that I've seen a team drive down their labor cost in their high end to such a low level, lower than their traditional and low end products. That's just kind of unprecedented. That was because of early investment in automation and whatnot there. Okay, so invested early and got those costs down, and they've stayed down. You know, $2.47. What's the other high end ones? Here's a SID is well, SID didn't make any. They must have had extra. High end here, $8.94. So look at that, $6.50 difference. Okay. And the high end here is the $6.75, so they've actually done a reasonably good job. It's still $4, over $4 difference than in the cost side of that product, you know. And when you're selling, 1.5 million, you know, you're talking about a $6 million profit difference, right? Based on that labor cost savings. So a lot of money that's come back to Andrews because of the investments that they made early on. Again, pursuing that strategy. Let's take a look. Let's kind of scroll down. Performance. You've really only got a couple products competing here. Erie, Andrews, you know, they did the best they did. Digby actually picked up a little bit, even though it's outside the circles. But it's pretty obvious that Andrews is way better position. Size, we're going to see same thing, right? Same exact thing. Interesting that E4 though, that product, they don't have to spend any money on it. That's kind of cool. They spent a little bit on research and development, but they sold, a couple hundred units, a couple 100,000 units, I guess it would be at a high price. Should have a good, and it doesn't break it out, if we looked at their size products, but should have a good, pretty good profit margin on that. I guess you guys could look at that on your own on your own income statement. Yeah, the perceptual map, again, we see, this pretty much vacated in the high end, so pretty much conceded to Team Andrews is largely what happened. Erie obviously trying to compete a little bit, Chester a little bit, just in the Chester in the high end is the only place it's kind of competing, but otherwise everybody else is gone. So basically they've conceded those to Andrews. But what's interesting is Andrews not only has won those, but you would think then with all these others down here, that maybe there would have been some concentration of effort down here, but Andrews is still dominating, not as much, but still dominating in those categories. Again, huge investments here in HR, resulting in a 22% decrease basically in labor costs because of productivity that much better. Baldwin does pretty good there. A lot of the teams have tried to do some catching up there and done so effectively. You guys had wage negotiations. I can see that's interesting. Looks like Andrews could afford to pay more and did. Maybe benefits a little bit more. Yeah. So they had 0 strike days, which was kind of a big deal, whereas Team Chester ended up having 54 strike days, which would have impacted them for that round. Won't impact them for future rounds. TQM, you see the big investments here. Both Erie and Andrews. It kind of looks like then that they've topped out here, right? I mean, you're not seeing any more, not driving this anymore than that. But those are huge percentages. Again, a labor cost reduction along with the productivity index and along with the automation that Team Andrews has done. it's just huge in terms of driving those costs down. And again, this is a differentiating company that, I'm not going to downgrade them because they're driving down costs. These aren't mutually exclusive. They're obviously dominating in terms of their strategy, right? Because they're out here in front, they're spending more on marketing, they're doing all those other things. And that doesn't mean they can't drive down costs, right? Companies drive down costs all the time, even though they're not, Tesla. I mean, that's more of a high-end vehicle, right? Or BMWs or Mercedes. They still do everything they can to drive down costs on those products. Maybe not to the point of sacrificing quality, right? But driving down costs in other ways that they can. So there you have it, kind of a look. I guess we'll take a quick look at the winter spreadsheet, although I have to admit this one lacks any suspense whatsoever. Okay. I hate to say that, but this one really lacks suspense, and so we'll just get right down to the meat of it. I guess the only suspense was whether or not Andrews could pull off the perfect 100, and they could not. Their cash flow, in spite of borrowing all that money, that kind of surprised me, was second to Chester's. And Chester even paid a dividend. So 99.5, but far outpacing any of the rivals. Okay, about 20 points. Really, Digby came in a second place there because no deductions, whereas 4 of the other 5 teams had deductions. So there you have it, round 6C. Good luck next round.